Ever pondered over the workings of the stock market and how you can benefit from it? Today, we delve into the fascinating realm of stock market investing. We'll unravel the intricacies of this marketplace for buying and selling stocks. Discover the benefits of investing in stocks, particularly long-term wealth accumulation and inflation protection. Learn about different types of stocks and how to set investment goals based on your risk tolerance. Gain insight into fundamental investment strategies and get guidance on how to start investing. Lastly, we'll share tips on how to sidestep common beginner mistakes. So buckle up for a journey through the world of stocks and investing. First, let's demystify what the stock market is all about. It's a platform where investors buy and sell stocks, essentially fragments. When you purchase a stock, you gain partial ownership of the firm. These stocks are issued by companies to gather funds for growth and new ventures. The stock market ensures these transactions happen in a controlled environment. The value of a stock fluctuates based on factors like the company's financial condition and market sentiment. If the company prospers, its stock value usually increases, enabling shareholders to sell their stocks for a profit. Some distribute a portion of their earnings to shareholders as dividends, providing a steady income. However, stocks can also lose value, leading to potential losses. Thus, understanding the risks of stock market investments is vital. Basically, investing in stocks wagering on a company's future success. The stock market plays a pivotal role in the economy by helping to raise capital, offering investors wealth-growing opportunities, and influencing economic policies. It's not just about profit, but also strategic decision-making, taking risks, and learning from the journey. Now that we understand the basics, let's delve into the benefits of investing in stocks. Why should one consider investing in stocks? Let's find out. Investment in stocks means acquiring part of a company and reaping benefits from its success. The allure of stock investment is manifold. Stocks offer significant potential for the growth of your investment. Consider the rewards of early investment in a future global enterprise. Many firms distribute as dividends, enhancing your income stream or enabling repurchase of shares. Diversification is key. Investment in varied sectors reduces risk from single investments. Stocks also provide a hedge against inflation with return on investments predominantly exceeding inflation, thus maintaining your purchasing power. Historically, post-inflation stock market yield has been 7 to 10% annually, a potential indicator of wealth creation, although future results aren't guaranteed. But the true magic of stock investing lies in compound interest when reinvesting your profits, leading to exponential of your investment and your money working for you. Clearly, investing in stocks can be a powerful strategy for wealth creation, but not all stocks are created equal. Stocks come in different types, each with its unique characteristics. Like ice cream flavors, there's a match for every investor. Primary types are common and preferred stocks. Common stockholders have voting rights and potential dividends, a share of the company's earnings, while preferred stockholders have priority on dividends and assets. Key term: market capitalization or market cap, a company's total value based on outstanding shares. Large cap firms over $10 billion are stable but grow slower. Mid-cap companies between $2 billion and $10 billion are growing, as robust as large caps but faster. Small cap firms under $2 billion carry high risk but have rapid growth potential. Growth stocks are in companies projected to grow above average, often high priced due to high expectations. Value stocks are in companies considered undervalued, with stock price low compared to the company's worth. They're like a bargain. You can mix and match these types in your portfolio. The objective is to strike a balance between risk and reward. Stocks offer various appeals, from common stocks' voting power to the thrill of value stocks. As in an ice cream parlor, you can mix flavors. A diversified portfolio can include a variety of stocks, balancing risk and reward. With a better understanding of stock types, we must now focus on setting clear investment goals. Before you dive into investing, it's crucial to determine your investment goals and risk tolerance. These factors will shape your investment decisions. Initially, think about your goals. Are you saving for a house, your child's education, or retirement? Different goals require diverse strategies. Short-term goals may need safer investments, while long-term ones might allow more risk for higher returns. Next, consider risk tolerance. In investing, risk and return are intertwined. Higher return investments often involve more risk. Your risk tolerance is how much financial risk you can handle. It relies on your investment horizon, financial situation, and comfort with uncertainty. Long-term investors may withstand market variations. A secure income and savings may enable more risk. If you're okay with potential decrease in investments, your risk tolerance might be high. Remember, there's no one-size-fits-all investing approach. Your unique goals' risk tolerance should influence your decisions. It's acceptable to reassess your goals and risk tolerance over time. Your strategy can evolve with your life circumstances. Staying engaged, informed, and making sensible decisions is crucial. Clear goals and understanding your risk tolerance are key initial steps. Now let's explore some basic investment strategies. Investment strategies are the roadmap for your stock market journey. Just as you map a route for a trip, you don't dive into the stock market without a strategy. Let's touch upon some basic investment tactics. The first one is the buy and hold strategy, which is about purchasing stocks and holding on to them irrespective of market ups and downs. As history suggests, the stock market eventually trends upward, so even if your stocks devalue today, they appreciate in the future. Then comes dollar cost averaging. This process involves investing a set amount of money into the stock market at regular intervals. This can help cushion the blow of market volatility. When stock prices are high, your investment secures fewer shares, but when low, it buys you more. Thus, over time, this may lead to a lower average cost per share. After this, we have diversification, which entails distributing your investments across different types of stocks and sectors. This reduces the risk of loss if one sector underperforms. Diversification is achieved by investing in large-cap, mid-cap, and small-cap stocks and varied sectors. Lastly, we've got asset allocation. This strategy involves dividing your investment portfolio among different asset classes, stocks, bonds, and cash equivalents. The goal is to balance risk and reward by adjusting the percentage of each asset in your portfolio according to your risk appetite and investment objectives. Remember, there's no universal strategy in investing. Your optimal strategy will depend on your personal circumstances, including financial goals and risk tolerance. Regularly reviewing and adjusting your strategy is crucial as these factors change. Investing always involves a trade-off between risk and reward. High returns are generally associated with a high level of risk. A well-planned investment strategy can help manage this risk. With these strategies in mind, we're ready to take the next step, starting your investing journey. In the segment, we'll delve into the nuts and bolts of opening a brokerage account, researching stocks, and making your first trade, so stick around. Starting to invest might seem daunting, but it doesn't have to be. To begin, open a brokerage account, a virtual bank for investments. There's a multitude of platforms available, each with distinctive features. Some are geared towards beginners, providing user-friendly interfaces and educational resources, whereas others are designed for seasoned investors, offering advanced trading tools and market analysis. Selecting a brokerage involves considerations such as fees, customer service, and investment choices. It's also important to ensure that the brokerage is reputable and regulated by financial authorities. After setting up your account, start your research on potential investments. Get to know the firm behind the stock, its profitability, and financial stability. Companies' annual reports and financial statements are key. Look for data on its debt and competitors. Utilize financial websites and apps that provide stock ratings. To trade, know your order types. A market order executes immediately at the current price, while a limit order executes only when the stock reaches your target price. Determine the number of shares to purchase based on your budget and risk tolerance. Begin with a small investment, gradually increasing it as you gain confidence. Investing is not a one-time event, but an ongoing journey. Continually review your investments and market updates, adjust your strategy accordingly. You're now ready to make your first trade. But how do you decide which stocks to buy? That's a topic for another scene. Stay tuned. To make informed investment decisions, you need to understand key market metrics and indicators. Delve into these tools that can help evaluate stocks. Starting with the PE ratio, calculated by dividing the market price per share by the company's earnings per share, EPS. It indicates the amount you're paying for each dollar of a company's low PE ratio implies potential undervaluation. Next, consider the dividend yield. This ratio shows the annual dividend payment versus its stock price. High dividend yields may appeal to income-focused investors. Then the earnings per share, EPS, a profitability measure calculated by dividing net income by the number of outstanding shares. A higher EPS indicates more value. Another important one is the on-equity, ROE. It presents the profit a company generates from shareholders' funds as a percentage. Higher ROE denotes better efficiency. Finally, the debt-to-equity ratio, DE ratio, compares a company's total debt to shareholders' equity, indicating how a company is financing its growth. Higher ratio suggests risk. Remember, these metrics are useful, but not perfect. Use them alongside other information and industry context. Comparisons should always be within the same sector. Armed with these insights, you're well on your way to becoming a savvy investor. But beware of common pitfalls. Use these metrics wisely and stay updated with broader market trends and economic indicators. Even experienced investors can make mistakes. Let's identify some common ones to avoid. The lure of the stock market often results in impulsive decisions like chasing trending stocks. But investments should be made based on thorough research, not fleeting trends. Another mistake is trying to time the market, an unpredictable task even for experts. A better approach is dollar-cost averaging that buffers market instability. Overtrading is another pitfall, as it elevates transaction costs and potential losses. Instead, a long-term investment strategy is often more beneficial. Also, never overlook diversification. By spreading investments across different stocks, risk is minimized. To prevent these missteps, establish clear investment goals, know your risk tolerance, and control your emotions. Adhere to your plan, regardless of market volatility. Remember, investing isn't a get-rich-quick scheme, but a wealth-building journey. Avoiding these common mistakes can save you from costly errors. Remember, successful investing is a marathon, not a sprint. We've covered a lot of ground today in understanding stock market investing. We examined its purpose, underlined the importance of investment goals, risk assessment, and types of stocks. We also discussed basic strategies in starting your investment journey. Remember, start small, stay educated, keep for your financial goals. Your journey in the world of investing begins today.